Hi, I'm Jimmy. In this video, we're looking at a list of stocks that I would like to buy at some price. I call it my bullpen. You might also hear people call it a bucket list. Now, you might ask the question, why keep a bullpen of stocks? And the reason that I do it is as I'm analyzing different companies and as I'm doing deep dives and try to get a true understanding of the business, if I come across a company that I like, and perhaps I don't have the cash yet, or perhaps it's not quite at the price that I want to buy it at yet, well, I put it onto a bullpen, and that way these are the stocks that I try to stay on top of the research for. And then ideally, when they get to that price, I get to decide at that time if I do in fact want to buy it. Now, on my bullpen, on my list of stocks that I want to buy in my bullpen, well, I have a few different sort of key numbers that I try to keep track of. First, what am I calculating the fair value to be for that company? Generally, that's a calculation that I do after I do my research. First, I come up with the fair value for the stock before my research, and then I do a deep dive, and then that allows me to really fine-tune my calculation of fair value. That fine-tuning is what I keep on the bullpen. Then I add, what is my margin of safety? Again, the margin of safety is something that's, the riskier a stock is, the higher the margin of safety. So if I do my analysis of a company and I find there to be little risk in the company for whatever the reason, I would have a smaller margin of safety. If there's lots of risk, well, we'll go through some of those examples in a second. If there's small amount of risk, or if there's more risk, I'll add a larger margin of safety. So when we combine the fair value and the margin of safety, we get my ideal entry price. Ideally, I want to buy it below that number. Now, before we go into the list of stocks itself, I actually want to talk about a change that I made. So I changed my personal required rate of return. I was using a 7.5% required rate of return, and that was a premium over AAA corporate bonds. But as many of you know, inflation has gone higher interest rates have gone higher, and because of that, AAA corporate bonds rates have risen. So my reaction to that was to increase my required rate of return. Now, I actually did a video on this not too long ago. I will leave a link in the description below for that video if you're curious. But for now, let's jump in and look at the stocks on the list. The first stock we got is Disney. Now, Disney, I actually got a fair value. Using a 9% required rate of return, I got a fair value of about $80 per share. Now, I have a smaller margin of safety for a stock like Disney because Disney, the business, has a fairly wide moat, and that is a company that I think their brand is well protected, despite what appear to be some near-term headwinds for the company. So when we adjust our fair value for our margin of safety, well, we get an ideal entry price of $76 per share. Right now, the stock is trading up in mid-90s, so it appears that right now, Disney is slightly overpriced. Now, this is actually a good time to illustrate the impact of switching from a 7.5% required return to a 9% required return. So if using the very same numbers, if the required rate of return was 7.5%, well, this is what the calculation would have looked like. At 7.5%, Disney stock was getting a fair value of about $114 per share. Adjust that for margin of safety, we have a buy price below 108. And frankly, that's exactly what I was doing. Anytime you see a star like that, that means that it's a stock that I already own, but it is a stock that I would consider adding more to. So this was a stock that I bought, I liked, happy when it dropped below $100 per share, but then when I increased my required rate of return, no longer in the buy level, so I'm happy to just sit and hold this stock for the long run. All these stocks are long-term buy and hold opportunities in my mind. Okay, now the next stock on my bucket list is Microsoft. This is a stock I'd love to own. I don't own it yet because it just hasn't fallen enough to get there. But we're getting a fair value of Microsoft stock of about $174 per share. Add a small margin of safety, and I end up with an entry price of about $165. Right now, the stock's almost $100 above that. This is one of those I'm afraid that it might not drop down to my level. But I sort of have rules that I'm trying to follow, rules that I come up with a fair value using discounted cash flow and then wait for the stock to get there. If I have to miss opportunities to follow the process, so be it. Okay, and the next company on the list is Alibaba. And we can see Alibaba's line is green, and that is because the stock is currently below our calculation of fair value. I programmed this to turn green anytime the stock drops below the calculation of fair value. So at the end, you'll see which ones are green. But Alibaba's stock, we got a fair value of about $193 per share. Right now, the stock is trading closer to $115. after our fairly large margin of safety of 25%, while the stock still looks fairly undervalued. This again is a stock that I own. We can see that by the star at the end there. Okay, the next stock on the list is Apple. Apple's a stock, again, small margin of safety. These are companies, big blue chip companies, tons of cash, fairly stable businesses, wide moats that are difficult for their competitors to tackle. So Apple is another stock that I own, and I actually bought Apple when I was using my 7.5% required rate of return, but now that I've increased it, once again, it has drifted out of the buy range. But I would love to get this stock if it can get anywhere near $100 per share. Not sure it will, but if the tech stocks keep falling, I'd be happy to pick up some more then. In the meantime, I'm happy to sit and hold the shares that I do own. Okay, the next company is a stock I recently did a video on. That's CVS. So we can see that CVS, we get a fair value of about $91 per share. I added a reasonable margin of safety because this is a highly competitive business that can be heavily regulated, especially when we consider them owning Aetna. So the health insurance business is a heavily regulated industry. So I think that adds some additional risk, hence my larger margin of safety. That being said, I want to see this stock drop below $73 per share before I'd consider jumping in and buying it. Okay, next company we have is another defensive play in AutoZone. So AutoZone, we get a fair value of about $1,415 per share. Add a reasonable margin of safety again to this, because again, highly competitive industry, reasonable margin of safety, we get a buy price of about $11.32 per share. It's sitting way above that right now. Now, I've done an analysis on AutoZone in the past, and in recessions, AutoZone and companies similar to that tend to do quite well in historical recessions. So that might be one of the reasons that this stock is nowhere near our entry price, despite the fact that the stock market in general has pulled back a real lot. Okay, next up, we've got Home Depot, and while we're at it, I've also got Lowe's on the list. Now, we can see that both of these stocks, which I think have a reasonable risk level, well, I have them both at a 10% margin of safety. Home Depot has slightly better margins than Lowe's does, at least they have in recent years, and because of that, they appear to be trading at a premium, the current price, over our calculation of fair value. Lowe's, on the other hand, is currently trading very close to our calculation of fair value, although I'm not really willing to consider buying this one unless it drops below our ideal entry price, which accounts for the margin of safety. Okay, next up we have Intel. So we got a fair value of about $54 per share. Add a 15% margin of safety to that, we get an ideal entry below $46 per share. Now, this is in fact a stock that I own, hence the star down there, but I also think it's important to point out that when I first researched Intel, there was a decent amount of risk to Intel. Of course, they have big competitors like AMD, NVIDIA, Apple's producing their own chips. They have a whole bunch of competitors in this space, although I like this space in general, and Intel certainly has their advantages. But I had a fairly wide margin of safety. At the time, I had a 25% margin of safety because I was afraid that the company wasn't going to execute on the long-term plan that they were saying that they were going to execute on. Well, since I first bought the stock, they've replaced their CEO, which is with a CEO that I like much better now. They've rolled out a plan. They're spending a ton of money to improve their manufacturing capabilities, which again is exactly in line with what I was hoping that they would do. So because of that, I adjusted my margin of safety from 25% down to 15%. Now, this is a stock I've added a little bit of shares to because it is below my calculation of fair value, and it's something that I'm happy holding for the long run. But I bring that out because I think it's important to recognize that we can adjust our research. These are stocks, everything on this list, as new information comes out about these stocks, I try to keep up with that research. So I wouldn't look at, I'm adding something to the list and it's just stagnant, never moves. I update the fair value. That's why we have dates there. Those dates are the last time I calculated the fair value for each one of these stocks. I update those numbers and I try to keep up with the research in general. Okay, the next stock on the list is Visa. Along those same lines, we've got Mastercard. And these are two stocks, just like Lowe's and Home Depot. I'm happy to own either. If they both would get to our ideal entry price, I'd consider buying a position in both, maybe a half position in one, half position in another, and add a little diversification to the overall portfolio. But if only one gets there, I'm happy to pick one up. We can see I get the same margin of safety, a 10% margin of safety, which again is an indication of the risk in my mind. 10% margin of safety for each of the companies. So I'd love to jump in and buy these ones if they get there. I just need them to fall a bit further. Okay, the next stock on the list is PayPal. So PayPal is a stock that I do not own. I recently did a video on them. It is below our calculation of fair value. So the fair value is $90 per share. At a large margin of safety of 20%, we get an ideal entry price of $72 per share. Right now, the stock is slightly below that. I haven't pulled the trigger though, because as you can see by the green lines here, there's a few opportunities. We got a few other ones coming up in a second. And because I have a limited amount of capital and I'm slowly adding to each of my positions or slowly building up cash for the next position, I just haven't been overly excited about a stock like PayPal compared to some of the other companies on the list. One perfect example of that is the next one on this list, and that's Google. Google is a stock that I do own. I've added shares to this one a few times. In fact, this is one of the biggest positions in my overall portfolio. I'm getting a fair value of about $2,500 per share at a small margin of safety because, again, this is a company that dominates their industry and they have a ton of cash. They generate a ton of cash. And this, from a business perspective, seems very difficult for competitors to go up against. That being said, our ideal entry price is about $2,400 per share, and the stock is a reasonable amount below that. That is why I've continued to pick up shares. And that brings us to the next stock on the list, which is Meta, also known as Facebook. Now, we can see that Facebook is a stock that I own, or Meta is a stock that I own, and we got a fair value of about $230 per share because they generate, again, just like Google, a ton of cash. Well, we get a fair value of $230 per share, but I have a higher margin of safety because I do think that there's more risk with a stock like Meta than there is a stock like Google. So that added risk increases our margin of safety, which brings our ideal entry price to about $196. The stock is trading a decent amount below that, which is why I bought it. But given the choice, frankly, if I had cash today to invest, which I don't quite have enough for my next position yet, I like to save up until I get a full cash position and then jump in and try to buy a good one. But if I had a choice, if I had to choose between one of the stocks in this list so far, it's still Google. I haven't pulled the trigger again because it's already my biggest position. I don't want to overweight on Google. But between Meta and Google, because there's less risk in my mind based on the research I've done, Google seems like the better stock to own. Okay. Next stock on the list is Amazon. I just recently did a video on Amazon, got a fair value of $83 per share. Some margin of safety is required here because what Amazon did is that they really overspent on capital expenditures recently. During COVID, they ramped up how much money they were spending, how many facilities they were putting up, and they went way too far. Now, over the long run, I don't think that will hurt them too much, as long as they can smoothly execute that over the next year. But because of that added risk, I added a bit more margin of safety. I have a fair value, an ideal entry price of about $71 per share. Right now, I got the stock. Right now, the stock's trading at about 110, so I need to fall further in order to jump in and buy that one. Okay, the last stock on the bullpen for me at this point is Citigroup. Now, this is a stock that I also recently bought. Now, I did not value this stock using discounted cash flow because discounted cash flow doesn't work for banks. Instead, I used price to tangible book value. Using price to tangible book value, I get a fair value of about $75 per share. I added a larger margin of safety to this stock because Citigroup has had trouble growing their overall revenue. Their revenue has been fairly stagnant for the past few years, and although I like the changes that the new CEO is making, they're going to have to show me in order for me to consider, dropping the margin of safety. But for now, the stock is trading at a discount to our ideal entry price, so that is a stock that I've added to. Now, the most important part for you building your own bullpen is that after you come up with a fair value to see if the stock's worth researching, you then have to do a deep dive on that stock. Now, I did a video called The 8 Steps to Analyze a Stock, where I walk through how I personally go, the deep dive that I go through, where I find the documents, the whole process. So if you're curious, perhaps that's a good next video for you to watch. I get a link right here. I get a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.